Okay, students, we're back. This is video 7 for chapter 11. And I finished the last video talking about exercise 11-14. The video came to an end before I could really say anything about what we would do next, but we are up to preferred stock now. So preferred stock is just a different class of stock than common stock. Preferred stock usually has some characteristics that you need to keep in mind. Number one, different voting rights than common stock, commonly. Now, historically, preferred stock usually had no voting rights. It was non-voting stock. However, that's changed in the last 20 years or so. And some preferred stock now has what are called super voting rights. And a lot of tech companies have done that before their initial public offering. They have created some super voting preferred stock, issued that to the founders of the company, and allowed the founders of the company to maintain a lot more control while giving up a chunk of the common stock ownership. So some of the super voting preferred has as many as 10 votes per preferred share. So they talk about here Facebook and Snap have adopted that structure. Lyft is another one that has. So a lot of mainly tech type companies have done that. Now, dividends on preferred are usually at a fixed rate, usually either at a set amount per share. For example, it might be at $5 per share dividend, or as a percentage of par value of the stock. So par value on preferred stock is often actually very important compared to common stock, where par value is usually pretty meaningless. So if it's stated as a percentage, then it's a percentage of the par value. So $100 preferred stock with a 3% dividend would pay 3% of $100 or $3 per year dividend. And then preferred stock, the name preferred actually implies this, carries a priority over common stock when it comes to payment of dividends. Before common stockholders can get a dividend, preferred stockholders must have been paid all the dividends they're entitled to, including dividends for that year. So preferred stock can be either cumulative preferred or non-cumulative preferred. Your book talks about that down here somewhere. I was just looking at it there. Cumulative dividend preference. Um, Cumulative preferred means that if you do not pay a dividend on preferred stock in the current year, then next year that dividend carries forward. And so if you don't pay any dividends in one given year and you have cumulative preferred, then the preferred stockholders, let's say in 2019 you paid no dividends, so preferred didn't get their dividends. If you have cumulative preferred stock and you decide to pay a dividend in 2020, then the preferred stockholders get their 2019 dividend. That's what we call in arrears. That's dividends in arrears. And they get their dividend in arrears, and it talks about that right here. And then they also get their current year dividend before common stockholders can get any dividends at all. Now, dividends in arrears technically are not a liability. Remember, dividends don't become a liability until the board of directors has declared a dividend. So dividends in arrears must be disclosed, but they do not show up on the balance sheet as a liability. Now, non-cumulative preferred is talked about right here. And if you do not pay dividends in a given year and you have non-cumulative preferred, then those preferred stockholders just never get that dividend. Almost all preferred stock is cumulative. So, and one of the big selling points or the attractiveness of preferred stock quite often is to retirees or other people looking for a steady income stream. And so they buy it for the dividend. And so if you have $100 preferred stock, $100 par preferred stock paying a 3% dividend, that's $3 of dividend per year. Then a retiree comes out and they invest $100,000 in that stock. They're looking for a $3,000 dividend every year. That's the attraction. If they don't get their dividend this year, they don't want it to just disappear. So almost all preferred stock is cumulative. Now let me go back up to where we were and move back down through the material. So when you sell preferred stock, the journal entry is just as it was when we sold common stock. We debit cash for the amount of cash received. If we receive another asset in exchange for the preferred stock, we would debit that asset. We credit preferred stock at par value and then credit additional paid-in capital for any additional amount we've collected. Okay, now they talk about preferred stock redemption right here. Preferred stock redemption is exactly the same as buying treasury stock, except with preferred stock, we don't call it treasury stock, we call it redemption of the preferred stock. And let's see, they talk about the current dividend preference here. I've already talked about that. That's a feature of all preferred stock. They have a preference when it comes to dividends. And talk about cumulative and non-cumulative right here. And talked about that. And so let's look at a couple of homework problems. Okay, so right here, mini exercise 1111, determining the amount of a preferred dividend. So Colliers Inc. has 100,000 shares of cumulative preferred stock outstanding. The preferred stock pays dividends in the amount of $2 per share, but because of cash flow problems, the company did not pay any dividends last year. The board of directors plans to pay dividends in the amount of $600,000 this year. What amount will go to the preferred stockholders? How much will be available for common stock dividends? Well, the annual dividend is $2 per share times 100,000 preferred shares. It's cumulative. They didn't pay a dividend last year, so the preferred stockholders are entitled to a $200,000 dividend for last year, plus a $200,000 dividend for this year before common stockholders get any dividends. So the answer is 400,000 would go to the preferred stockholders and 200,000 to the common stockholders. So we see that there. That's the past year dividend. The current year dividend, those are on preferred stock. So the preferred stockholders get 400,000 and the remainder goes to the common stockholders. Now we go down to the next one and it says refer back to this one, but assume the preferred stock is non-cumulative. What amount will go to preferred stockholders and how much will go to the common stockholders? Well, if it's non-cumulative, that dividend that was not paid last year goes away. And so the preferred stockholders would get their dividend for the current year, $200,000. The other $400,000 would go to the common stockholders. So, okay. Now let's move on. Wrong one. So they talk about retained earnings here. We have talked about retained earnings enough. I don't think we need to talk about it more here. They talk about when retained earnings are negative because of losses, it's usually called an accumulated deficit or accumulated losses. Statement of stockholders' equity. Now, what generally accepted accounting principles require as far as financial statements are basically an income statement, a balance sheet, a statement of cash flows, and a statement that reconciles beginning and ending retained earnings, often referred to as a statement of retained earnings. However, most corporations, rather than issue a statement of retained earnings, issue a statement of stockholders' equity. Now, what the statement of stockholders' equity does is it takes all stockholders' equity accounts, including retained earnings, and reconciles their beginning and ending balance. So it fulfills the requirement for a statement that reconciles the beginning and ending balance of retained earnings, but it provides a lot of additional information. So we see here all of the stockholders' equity accounts and their beginning and ending balances are reconciled. Okay, so we have exercise 11.3. Right here. So Northwind Aviation received its charter during January, authorizing the following capital stock. So they have 8%, $10 par, preferred 20,000 shares authorized, and common stock $1 par, 50,000 shares authorized. Following transactions occurred during the first year of operations in the order given. So we're to prepare the stockholders' equity section of the balance sheet. So we're going to reconcile beginning and ending balances of all the owner's equity accounts. So A, they issued a total of 40,000 shares of common stock for $15 per share. So the common stock had a par value of $1. So we're going to see an increase in common stock of $40,000. And then we're going to see an increase in additional paid-in capital of $14 per share. The $15 per share it sold for minus the $1 par times the 40,000 shares. So we'll just go on over and look at that. And so we see here the contributed capital. So here is common stock, authorized 50,000 shares. They have issued, right here is the first issue. So the first amount contributed to additional paid-in capital. There is the $15 selling price minus the $1 par times 40,000 shares. And then we're going to see in a little bit they're going to issue some more stock for $20 per share. So we will go back, and then they issued 10,000 shares of preferred stock at $16 per share. So it had a par value of $10 per share. So they have $6 per share of additional paid-in capital, which would be $60,000, and $100,000 for the preferred stock. So here we see the preferred stock. Well, again, they must have sold some more stock. I should have reviewed these homework problems earlier before I started, and I didn't. So shame on me, but they issued 3,000 more shares of common stock at $20 per share and 1,000 shares of preferred stock at $16 per share. So they have 11,000 shares of preferred, all issued at $16 per share. So we see that right here, the preferred stock. The 11,000 shares times $10 per share par gives you 110,000. Then we have 11,000 shares times $6 per share because the issue price was $16. So additional paid-in capital was $6 per share. $16 selling price minus the $10 par.